Hey everyone, welcome back to the channel, your number one source for income-oriented investing, and it's time for the overview of the income landscape. I'm going to go over what I feel are the top income-oriented funds on the US market, guys. So this is the US episode. Don't forget there was a Canadian one or the Canadian listed funds covered in a previous episode. So this is really for my American friends, my American viewers, and Canadians as well, because if you're like me as a Canadian, I invest in US listed funds in the RSP, in the Lira, because there is no 15% withholding tax because they are retirement accounts. So what we'll do, as usual, everyone, we will take a look at what the market has done, the overall US market has done in the last month real quick, and then we'll go over all the funds. So, and by the way, just a quick reminder, in case you feel like I'm going too fast, my voice is too fast, you could always slow it down in your YouTube settings. So let's take a look at, of course, what I feel is just the best indicator of all time for the overall US market, the SPX or the S&P 500. Just Google SPX and you'll get it, guys. So in the last month, the S&P 500 is up 2%. So May was a pretty good month, to be honest. April was not that great. May was good, and especially the Nasdaq has been on a tear lately. It's still going, it's still breaking records. And by the way, the symbol or the code for the Nasdaq 100 index is NDX. So you could just Google NDX. So doing even better than the S&P 500, up over 3% in the last month. And just a reminder, I am filming this on June the 4th while the market is still open. So I know everyone's on edge and still waiting for those rate cuts. I think that's really the next big thing for the market to keep going up. I think it will continue to go up over time, right? That's just what the market does. And as a long-term investor, that's what you should really be focusing on, the long term. So I personally don't really follow the news day to day, month to month, what's going on exactly. But if ever you're interested, there is an application or an app, mobile app called Stock Pick. Very interesting. I tried it out myself. What I like about it is that this app is specifically designed for retail investors, and it is politically neutral. I repeat, it's politically neutral. So if you want to try it out for free, the premium, you could try it out for free for 2 weeks using my referral link. It's in the affiliate and referral link section. And if you're interested in trying it out and signing up for a year, you get 25% off, guys, with my code. And I believe it's with my referral link. So I believe it's $80. So you could get the annual subscription. You could try it out for a year for $60. So check it out. Try it out for free. The link is in the video description below. So moving on, let's go over all the what I feel are the top income-oriented ETFs and funds on the US stock market, and the list just keeps growing and growing and growing. I really feel like, the US market has been on a tear for these new ETFs. So let's get started. I'd like to thank the sponsor of this series, of this video, Curve, who has some really innovative single stock covered call ETFs. So they have Apple right now, they have Amazon, they have Google, they have Microsoft, and they have Netflix, Tesla as well. So these are the ones that they have currently. I am, watching them closely for the new products that are going to be coming out. I'm sure there's going to be some. So check out Curve, guys, if you're interested, especially if you like investing in, the big names like Apple, Microsoft, Tesla, but you're an income investor and you want income. These guys do covered calls or synthetic covered calls on individual stocks. So you could get lower risk than owning, just a Tesla, just a Netflix, etc. And you could get some really, really nice yields, as you could see here, right? 26% on the Tesla, Netflix 17. Of course, those are more volatile. Things like Microsoft, Google, Amazon, and Apple will have less yield because they're less volatile, but over 10%, which is really, really cool. So moving on now, we'll go through, of course, first we'll focus on the diversified or the index-based covered call ETFs. Of course, we have the OG here, QYLD, which not much to report. It's just a rinse and repeat process, right? But the latest distribution here in May or end of May is a little bit lower, and that doesn't surprise me because volatility has been lower in May. You could actually see the little decrease in volatility, right? So these guys just do an at the money call every month, and they give out they give out 1% of it, or half of the premium. So the Nasdaq 100 premium was 1.84. It wasn't even 2%, which means they actually gave out less than 1% this month. That's why the distribution is a bit smaller than the last month. But this is just a rinse and repeat, guys. Of course, remember there's always XYLD for the S&P and RYLD for the Russell 2000 as well. Same strategy, rinse and repeat. Moving on to the OG, the biggest, not the OG, I would say the biggest and most popular covered call ETF on the US, JEPI, and JEPQ as well, which is doing really, really well. You could see that the assets, I mean, I think it's going to pass JEPI, guys. It's almost at 14 billion. And it's relatively a newer ETF. JEPI has been around for a lot longer and is at 33 billion here. So I think JEPQ will eventually surpass. Maybe I'm wrong. But JEPI and JEPQ did recently announce their newest distributions. So JEPI, a nice little increase here from 32 cents to 36 cents, which I kind of find surprising because volatility was a bit lower, I feel. But hey, always a welcome news. I mean, like I discussed with Hamilton Rainier on the Q&A I did with him, the guy who actually manages, the head manager of these two ETFs, this guy right here, JEPI, you could expect about 7 to 9% yield annually, and JEPQ about 9 to 11. These are just general guidelines. So if we look at the JEPQ distribution, it also went up a little bit, almost at 45 cents. And yeah, JEPQ, I'm a big fan of JEPQ. I like it better than JEPI because I feel it's more correlated to JEPQ is more correlated to the NASDAQ 100 than JEPI is to the S&P 500. JEPI is more like defensive stocks inside the S&P 500. It's not really the S&P 500. So moving on, you have GPIX and GPIC with a Q from Goldman Sachs. These are actually very similar to JEPI and JEPQ, except they're the actual indexes. And they're actually both outperforming JEPI and JEPQ. Doesn't really surprise me. So these are the actual indexes. So GPIX, the latest distribution, 33 cents, a little bit higher. So this one is honestly doing phenomenal, guys. In terms of like S&P 500 index covered call ETF, I believe GPIX is the top performer, the one with the highest total return thus far. Doesn't surprise me. It also has a very low fee, a promotional fee of 29 basis points instead of 35 basis points like JEPI, but that's just a promotional. I think it's going to go to 35 basis points eventually. So GPIX around 8% yield, S&P 500, guys, and GPIC with a Q. Also nice distribution here, very consistent and going up with time, which is phenomenal. GPIX is about 10% yield, so which of course is normal because the NASDAQ has a little bit more volatility than the S&P 500. So you'll always get a little bit more yield with a NASDAQ 100 covered call ETF. So these are, in my opinion, guys, if you're okay with 8% yield, 10% yield, total return is very important to you. These are definitely the ones you have to consider, in my personal opinion, in terms of index-based covered call ETFs. Moving on to SPY-I and QQQI from NEO. So these ones, I feel like their specialty or the strong point about them is they're higher. They have higher yield. So SPY-I is about 12% yield. QQQI is about 14.5. But what I really feel is strong with them is their consistent monthly distributions. They're very similar in terms of amounts every month. They don't vary as much as JEPI and JEPQ, for example. And the yield is very high. So SPY-I, the S&P 500 one, guys, is typically 1% a month. It's typically 12% yield. QQQI, its twin sister or brother, which is the exact same strategy bid on the NASDAQ, of course, is going to be higher. It's about 14.5%. It's a bit newer, 4 dividends or 4 monthly distributions. And you could see my estimate from what I'm seeing here is that it's going to be very similar to SPY-I in terms of very good consistency every month in terms of the amount you're going to get. So these ones here, and I know on the US side, there's just so many now. So I'm trying to give you what I feel are the strong points for each one. When it comes to SPY-I and QQQI is definitely high yield, right? Higher yield, but consistent monthly dividends. I feel like that is really the strong suit for the NEOS ones. And we have others. We have BlackRock that just joined the game here. You have IVVW. This is the iShares S&P 500 buy right ETF, which literally means covered call ETF. The strong point about this one by far is this is the lowest fee S&P 500 covered call ETF in America. It's 25 basis points. It's also a rinse and repeat strategy, by the way. I will have a review video coming up on this. It's basically 1% out of the money written every month. So you're giving up a little bit more of the upside of the S&P 500 for this one for a little bit higher yield. But the strong suit for this one is definitely the very low MER. It's the S&P 500 covered call ETF with the lowest management fee. The third distribution was declared, I have to say, a lot lower than I expected because 1% out of the money, you're going to get a big premium, but I guess it's because volatility was lower. So I find it weird. 66 cents, 62 cents, 40 cents. That's a big drop, I feel. So you're definitely not, I feel with this one with BlackRock, and this is similar with other BlackRock products like TLTW, they're going to be all over the place, and they're not going to be as consistent every month. So right now the yield, for example, on based on this latest distribution is about 9% yield, which is still pretty high, but it's a far cry from the 15% like the last two. So we'll definitely keep an eye on it, guys. But if having paying the lowest fee is important for you, you want pretty high yield. Obviously you have confidence in BlackRock, the biggest asset manager, definitely should consider IVVW as well. They don't have a NASDAQ one, but they have a Russell 2000 one, and this is the lowest fee Russell 2000 covered call ETF at 39 basis points. Instead of, and again, just like IVVW, it's also rinse and repeat, but it's 2% out of the money every month instead of 1%. So you're getting a little bit more upside on that Russell 2000. And the latest distribution, just like IVVW, a pretty significant drop here. So this is maybe something like 12% yield or something like that. But again, looks like these distributions are going to be a little bit more, there's going to be more variance. It's going to be a little bit more all over the place compared to, for example, a SPY-I or QQQI. But hey, if you like the Russell 2000, if you into the small caps, I feel this is definitely one to consider for sure. In my opinion, a bit better or a lot better than RYLD, for example. All right, moving on now to the daily options strategy ETF. So index based, but these guys do daily options. So we have the ones from Defiance, from Roundhill, and ProShare. So let's go through them. You have QDTE for the NASDAQ 100 and XDTE for the S&P 500. So what's really special about these ones, guys, it's one, they do daily options, daily covered call options, and they have their very unique weekly distribution. So the Roundhill ones are the only ones that do weekly distributions. It's for QDTE, it's been 21 cents for the last 2 weeks, so very, very similar here. For the S&P 500 one, I believe it was also very similar like last week, a little bit higher, 13 cents to 16 cents. So again, you will see variance here as well. You see, 1 month it was 25 cents, 23 cents, 34, 13, now 16. So you can expect also some variance as well with these ones. But if weekly distributions is really attractive to you, you could check these ones out. Of course, we have the first OG daily options covered call. It's QQQY, JEPY. So obviously QQQY for the NASDAQ. This is the one I personally own right now in my retirement account on Drip. They just released the latest distribution, which I was surprised. I thought it would be lower than 80 cents because volatility was lower in May. Still very, very strong at 80 cents here, guys. Over 60% yield. But remember, my opinion, these are not really ideal to live off of, to extract all the dividend. They're best dripped. Same thing for JPY. Nice yield, still over 40% here. Latest distribution, definitely lower than last month. Doesn't surprise me, 55 cents. And then you have the Russell 2001 IWMY. I guess, you could compare it to this one. So just change the W. It's IWMW, and the Defiance one is IWMY, and you'll get the Russell 2001 from Defiance. So very, very high yield. The Russell has even more volatility than the NASDAQ, so it doesn't surprise me that this one is the highest yield. It's growing very quickly. Obviously, people love the high yield. And the latest distribution was a big drop from last month. Again, not a surprise. Volatility is lower in May from $1.41 to 91 cents. So still a very, very, very high distribution. And my personal favorite product from Defiance now is SPY-T. I can't wait till they come out, hopefully, with the NASDAQ version and the Russell 2000 version. They did file for them, but right now only the S&P 500 one is out yet, SPY-T. So I swapped my JEPY, in case you didn't know, to SPY-T. I feel like it's a superior option strategy for me, and it's actually a target yield strategy. Targets 20% annually, and compared to JEPY, it captures more of the upside of the S&P 500. So that's really the difference between JEPY and SPY-T. SPY-T obviously has lower yield, but it captures more upside when the S&P 500 goes up. And what they do is a daily credit spread on the S&P 500. You could actually see here. So a credit spread is you're selling a covered call and then you're buying a call simultaneously at a higher price, and you make the difference. That's the premium, right? So it literally holds IVV, which is the BlackRock S&P 500, right? IVV. By the way, IVVW also holds IVV. Makes sense because it's BlackRock, right? If you look at the holdings, you see that it actually holds IVV, and then they just write the monthly covered call, which you could see here. So SPY-T does kind of the same thing. It holds IVV, and it does a daily credit spread on the SPX, on the S&P 500 index. You could see that here. So also declared latest distribution, you're a little bit higher than last month. With SPY-T, I'm expecting a lot more consistent monthly distributions than JPY because it's a target yield product, right? They're targeting 20%. So I feel like in terms of strategy, this is the one I feel is the best for me in terms of daily option index ETF. So this is the one I have, and most likely I can't wait for QQQT when that one comes out. Last but not least, you have the ProShares one. These are the lowest fee daily option ETFs at 55 basis points. So iSpy is the S&P 500, IQQQ the NASDAQ 100, which this one is fairly new. And this is just a daily covered call that they do, daily covered call option. It's monthly distributions. They have the lowest yields out of the daily, but out of the daily option ones, right? QDTE, the Defiance ones, and these ones, right now they have the highest performance. So iSpy actually has the highest performance. Doesn't really surprise me because it has a significantly smaller fee than the other ones at 55 basis points. But the yield, you're looking between 8 and 10% yield, guys. Not really super crazy. You're going to have similar yield to GPIX and JEPI with iSpy. So lowest yield, but the lower your yield is, you're just capturing more upside. So obviously it's going to perform better if the S&P 500 and if the NASDAQ 100 goes up. So this one I believe is about 10% yield right now. Okay, 8.5 here. Based on the last distributions. Let's go back and let's go see what the latest distributions are. So you got 35 cents monthly, 29 cents for the NASDAQ one, and then for iSpy, which has been out for a lot longer, for a couple of months more, you see that, yeah, it went down a bit. So these are definitely ones, again, if total return is very important to you, and you want to capture as much as you can of the S&P 500 and the NASDAQ, these are what I would say are kind of daily equivalents of the GPIX and GPIC. So if you really like the daily option strategy and total return, those are your two prime objectives. I would definitely consider iSpy and IQQQ from ProShares. All right, that's it for the index-based covered call ETFs. There's just more and more and more options, which is great. I do have a video plan to go into detail to really do a comparison between all the S&P 500 options and NASDAQ 100 options, give you the strong suits, which I kind of did in this video, of each one to help you really decide which one is best for you. It's all about figuring out what's best for you guys. What is the top, what is the objective? What is the most important thing to you? Is it yield? Is it total return? Is it lower fee? Is it monthly distributions versus weekly? So there's no right or wrong to which one you choose for your portfolio. And don't forget, you could always mix and match as well, right? So moving on to Yield Max. So Yield Max ETFs, guys, this is these are managed by Jay, who I've had on the channel several times. In my opinion, YMAX is definitely the best option because it's the all-in-one, right? Every time a new Yield Max covered call ETF comes out, it's going to be added into YMAX typically after a month. So things like other all-in-ones like Alti will not be added, and YMAG will not be added to YMAX. It's just going to be the covered call ones as well as the short ones, right? So the short ones, like the first one just came out, Tesla short, that is not going to be added to YMAX. So YMAX is going to have really the covered call ones, not the short ones. So I expect YBIT and even GDXY, they finally came out with the gold miners one. So this is actually the second ETF that they have, right, after OARC. So OARC is the ETF that they come out. It's literally covered calls on an ETF. So this is the second ETF style one, and it's gold miner. So this one is definitely going to be added to YMAX. And I just think YMAX is eventually going to get better and better because it's going to get more and more diversified as the new ones are getting added in, right? So Yeah, that's what's new with the yield max. Moving on to SVOL, one of my personal favorite alternative income style ETFs. Nothing really to report here. They're about to crack the 1 billion in total assets. The latest distribution has been declared, still at 30 cents. And I really like what they're doing is they're starting to add, I guess because the VIX premiums, the VIX is so low, volatility is so low, they had to add some of their ETFs to SVOL just to get that yield up there. So they added AGGH, BUCK, CDX, and MTBA. So these are all kind of fixed income style ETFs with option income. So about a third of SVOL now, guys, if you just add these up, about a third of it is other simplified ETFs. I think other 2/3 is treasury bills or government bonds, and then they're doing that short VIX strategy. So very, very nice consistent distribution, very, very good performance as well, and it is now Simplify's highest and most highest AUM and most popular ETF. They do have high, which is a little bit lower risk than SVOL. They did recently, and it's doing really well doing well as well. But the yield is a bit lower. Look at about 6 or 7% yield. And this one just does credit spreads. That's all it does. It holds T-bills and it does credit spreads on the S&P 500, on ARK. It just does credit spreads on random things here. And this one recently lowered their distribution. It was 20 cents and it went to 16, 14, and now it's the latest one's at 14. So hopefully we'll stay. Pretty sure we'll stay at 14. I mean, it should be very, very easy to get a consistent 6-7% yield with this one here. And the stock price has been very, very, very stable, always near the $24-25 mark. It does have some competition. So this is one that I've been monitoring, the SOFI Enhanced Yield. I don't know if it's SOFI or SOFI. THTA, that is the stock symbol. And it also does credit spreads. It holds treasuries. It does while doing option trading, which is credit spreads here. So it's very similar to what high does, except the yield is actually much, much higher. And the monthly distributions have been nothing short of very impressive. So if you like high, if you like these type of alternative income ETFs, I would definitely take a look at it, or at least have THTA on your radar. It even has a slightly smaller management fee than high, MER, at 49 basis points. This one, I believe, yeah, it's at 51. So this is definitely one to consider if you just want an alternative income ETF that gives you very nice high yield using credit spread. So moving on to the fixed income world, which is not my personal favorite, but we'll cover them anyway because I asked you guys last month, do I need to go over these ETFs? And you all said yes. So in terms of fixed income, I feel the most well-balanced one is AGGH because it's spread out throughout the fixed income world. It's not just government bonds or just corporate bonds or whatever. It's a bit of everything. Pretty high, pretty nice yield of about 8%. Low MER, and this one also, I believe, lowered their distribution slightly. Yeah, 20 cents to 14. So they declared it again at 14. So if ever you like fixed income, guys, you want to add fixed income to your portfolio, think of this one as a diversified fixed income solution. I talk about it with Silesh, by the way, because remember now it's a 10% holding or 11% holding in SVOL, right? AGGH, you see that it's 10.5% of SVOL. I personally will always go with SVOL instead because AGGH is actually in there, as well as BUCK, which is even lower risk. You also have the corporate bond one and you have the MBS one, the mortgage one. So, but if you really want specifically only fixed income, you have AGGH as an option. And of course you have the 3 iShares where you have to get the 3 types of fixed income separately. So TLTW is government bonds, LQDW is investment grade corporate bonds, so high quality corporate bonds, and then you have what's commonly referred as high yield corporate bonds or junk bonds, which is HYGW. So out of the 3, HYGW is definitely doing the best, because obviously it has higher risk in the fixed income world. In terms of risk, right, government bonds is the lowest risk, investment grade corporate bonds is on top of that, and then the highest risk or a higher risk would be the junk bond, the high yield corporate bonds, and this one is actually outperforming both of them. But again, just like the other BlackRock product, guys, you're gonna have to expect big swings with the monthly distribution. So You could get all three. You could, if you want to pick one or the other. If it was me, I would go with HYGW. And again, AGGH has, everything. Government bonds, corporate bonds, it just has everything. Moving on to Bitcoin now, you have Maxi and YBTC. So Maxi declared no change, still 15 cents a month. For me, this is my personal favorite way to get access to Bitcoin because they're not doing covered calls on Bitcoin like YBTC is. They're investing in Bitcoin futures and they're doing credit spreads. So, Simplify obviously loves doing credit spreads for that additional income. So the way I look at it, you're not getting much yield. You're looking at 6-7% yield. Or another way to think about it, guys, is that Maxi is literally high with Bitcoin exposure. That's the easiest way to think about it. In fact, I don't even know why. They could just put the high ETF in here and it would kind of be the same thing. But anyway, what I like about this one is you're not capping your Bitcoin upside, right? Like YBTC is, because YBTC actually does covered calls on the BITO, the BITO ETF. You actually see the calls here. I do like the fact that you could see how much upside you have left until the expiry here. But obviously you're going to get a crap load of more yield, guys, with YBTC. You could see these monstrous monthly distributions here with YBTC. Very, very, very high yield, but you're capping your upside to Bitcoin. So for example, right now Maxi is outperforming YBTC by a lot. But if, for example, Bitcoin flatlines, well, then YBTC is going to start beating Maxi, right? But if you're really optimistic, you're investing in Bitcoin for the upside, but you're an income investor, I would go with Maxi. If you're really skeptical about Bitcoin, you don't really care about what it does, you just want maximum yield off of it, then YBTC is the better option. But I have my Maxi on drip, guys. So I feel like every time that drip goes through, I'm kind of buying more Bitcoin in a way. That's just how I feel about it. So no changes in terms of distribution, still 15 cents here. Moving on, there is FEPI. So FEPI is probably one of the, there's not many sector specific covered call ETFs on the US market. Global X does have a bunch of them, but they're kind of very low yield. FEPI is definitely a great one if you want technology. So this is a technology covered call ETF, and the yield has been a very, very consistent 25%, which is very impressive. This is literally, it's been out for over 6 months now. You could see here, even the latest distribution, a little bit higher here. And this is top 15 technology companies. You'll recognize all of them, guys, right? You'll have the Magnificent Seven in there. You'll have NVIDIA, et cetera, et cetera, et cetera. This is really the top 15 technology companies. I do have a video going into this one in detail if you want to check it out. But if you really, really love technology stocks, even more than, forget about the NASDAQ 100 because that's very technology focused. If you just want technology stocks and you're an income investor, FEPI is definitely one to consider. You have Clip, of course, from Crane Shares. This is technology stocks, or in the Chinese markets, it's literally covered at the money covered calls on KWEB, the KWEB ETF, which is a very, very popular index-based ETF covering technology companies in China. Top two stocks is Alibaba and Tencent, right? So this one has actually been doing really well because KWEB has been flatlining. So Clip has been outperforming KWEB. I did a recent video discussing an update on Clip with the guys at Crane Share, so make sure to check it out. But if we look at the performance, I have to say very, very impressive. Average annualized just under 10%, 9.5%, which is since inception, which is very, very very impressive. Very impressive. It's actually outperforming KWEB. So very high distributions, monthly distributions as well with KWEB. And that is the end of the ETFs. Well, not really, but moving on to more alternative stuff like closed-end funds. So let's take a look at CLM. So CLM right now is at a 9.2% premium. Not bad buying it. Remember, everyone, if you're watching this, my opinion, CLM, it's only best for Americans that could drip it at NAV. Okay, so that is really the special thing about CLM. I made my last CLM video talks about this in detail, so make sure to check it out. Moving on for the closed-end fund. So there's 3 closed-end fund all-in-one options, which means these funds or ETFs have multiple closed-end funds in them. You have RIV, which is a closed-end fund itself, still trading at a 3% discount, so still a good pickup. You have YYY, which holds 45 closed-end funds. not performing as well as RIV and CEFS. My opinion on why is because it's mostly skewed towards fixed income. You see that 86% of YOY is closed-end funds that invest in fixed income and bonds, only 14% in stocks. So I think that's why the performance hasn't been super good for YYY. RIV a lot better, right? If we look at performance, it's a lot better. It's net asset value, the NAV, it's over 8%. Stock price, it's at 7%. But the best performer by far is CEFS. This is an ETF that holds many closed-end funds. The yield's about 8%, but the performance has been nothing short of really, really, really good. Over 9% average annualized since inception. And my opinion wise, because I believe it's focused more on the stock. I could be wrong, more on equity closed-end funds, and you can see they have big positions in which I feel are probably the best closed-end funds, the BlackRock one. And you just see here like what is that, 20, almost 30% is in ECAT and BIGS, and BIGS is all technology stocks. So I think that's why CEFS is doing really well. So if you want to get into the closed-end fund game, you want an all-in-one option, these are the three I would look at, guys. The one with the highest performance by far is CEFS. This is actually an ETF. And I also wanted to mention, because BDCs, business development companies, are really popular in the, especially in the U.S. If you're an income investor, they do have really nice high yields. BDCs are basically companies that lend money to small and medium-sized businesses, and it's pretty much kind of like investing in fixed income. But the rates are higher, right? Because it's not like a government bond. These are more risky loans. So that's what BDCs do. If you want an all-in-one BDC ETF, you don't want to pick and choose BDCs, go with the Van Eck BizD ETF. It has exposure to all the BDCs. You'll get about 9-10% yield. I think this is the best option if you want to get into the BDC game as an investor as an American investor. You see that the returns are not so bad. Last 10 years, over 8% annualized, which is pretty good. And if you scroll down, I believe you'll be able to see eventually so Eris, of course, I think it's the biggest BDC. So of course, this is going to be number one holding. Owl, and then so this is basically a market cap weighted BDC ETF. So you see how big these are just the biggest BDC, so they make up like 50% or more of this ETF. So just giving you that option, guys. So that's it for the overview. The US income landscape is getting bigger and bigger and bigger, and hopefully this video doesn't get too long, but my intention is really to make sure you're updated, guys, on everything. I try to track everything myself. I'm sure there's funds that I haven't missed, but in my opinion, as always, the core foundation of your portfolio should always be the index-based, either S&P 500 or NASDAQ 100, maybe even the Russell covered call ETFs, which you have a whole bunch now to choose from. And if you want to go into more niche things like the yield max stuff, the curve stuff, which is single stock or fixed income or things like SFOL, you could add those as well, BDCs as well. Nothing wrong with that. But my opinion, the core foundation as an income investor, just like a growth investor, right, is the index-based S&P 500, NASDAQ 100 ETF. So that's it for the overview, guys. We're going to do this again next month. Did I miss any really, really high yield income-oriented funds? Let me know. And if I feel like it's worth it, I'll add it to the list here to review every single month. But we're going to do this again next month, so see you next time. Hey, don't go yet. A few reminders before you leave. Did you know that I launched a YouTube loyalty membership program where for only $3 a month, you could become a PII Inner Circle member, where you will gain access to exclusive content, exclusive videos and live streams, as well as other perks and benefits, including a really cool weekly opportunity report. That's right. If you're interested, just click on the little join button next to the subscribe button to see what it's all about. Also, make sure to follow me on Blossom and download Blossom. It's a social investing app, which is really cool. You could share your portfolio, follow other people's portfolios, including my own. My username is Adrian_PII. So download it with the referral link below. Not only is it free, but you could actually earn cash by taking these really small, quick 1-minute courses. Really awesome. It's a no-brainer. Also, make sure to visit our website, PASSIVeincomeinvesting.ca. That's where you could book a one-on-one private coaching session with yours truly, with myself, where you could ask me all the questions you want All the information and booking information is on the website. Make sure to check out that video on the homepage there to see how to book a one-on-one properly. Also on my website, you could purchase my digital product, which I'm very proud of, the Ultimate DIY Investing Package. This is a reference tool or a companion tool that will help you build your own portfolio. So it has lists of funds, it has sample portfolios, and it covers both the Canadian and U.S. stock markets. And the good news is you'll only ever have to buy it once because it comes with free lifetime updates. And my plan is really to update the version every single year. So make sure to pick it up. Also, I have Questrade and PASSIV referral links below. So Questrade is the broker that I personally use, and PASSIV is the broker companion tool or assistant that I use. Really cool program, really cool software. So I have referral links for both of those. Questrade, $50 of free trades. And PASSIV, I have half off for the elite membership. If you're interested in the elite membership, and even if you want to start out with the free membership and upgrade to the elite afterwards, use my referral code so you could still get that 50% off. And don't forget that the elite membership of PASSIV is 100% free if you use Questrade. For social media, we have a very successful and big Facebook group, private Facebook group with over 14,000 members where we all try to help each other out. So make sure to join that group. Information is below. We also have Instagram where you could follow us or more personal stuff when it comes to our life here in Panama. And there's LinkedIn as well. So as usual, everyone, how do I leave you? Continue to stay safe, stay healthy, and of course, stay passive. See you next time.